back to the big picture theme of strategy, which has sort of dominated proceedings along with sectors and stages today. And to ask the question, new order, even more alternative strategies out there, it's my great pleasure to introduce, to moderate, Michael Collins, the Chief Executive Officer of Invest Europe.
Thank you very much, Tim, and good afternoon, everyone. Thank you for staying with us for the afternoon. As my fellow panelists are getting themselves settled, let me just say a quick word about what we're going to cover over the course of the next 25, 30 minutes. One of the topics for today has been the ways in which the private equity industry and the private capital industry more generally is constantly evolving and constantly changing. And in this next panel, we're going to really delve into some of the detail of what those developments are in the industry. You will all have downloaded the conference app or have a copy of the conference program, so you can see the more detailed biographies of my fellow panelists, but I'll let them just very quickly introduce themselves, name, institution, and job title before we dive into the questions.
I'm Pierre-Antoine de Selancy, and I'm a managing partner with 17 Capital.
And I'm David Enriquez with the New York City Retirement Systems on the private equity team.
I'm Laura Coquis. I'm a managing director at OMERS. Sorry about that. And I look after strategic partnerships.
I'm Blair Jacobson. I'm a partner at Ares Management, and I'm responsible for our European credit businesses.
Great. And throughout the panel, I'd be delighted to hear comments and questions from all of you, either by sticking up your hand the old-fashioned way, or by using slido.com, hashtag BVCA, and as you will have realized, we're in the main plenary room, so don't be shy about throwing your questions in. Laura, I'd like to start with you if I can, and start by thinking about how the world is looking different from an LP perspective. Do you sense that LPs are starting to lose interest in the traditional relationship with private equity funds and managers? Is it now going to be a different way in which LPs are looking to access private markets?
Well, I mean, OMERS has kind of an evolved perspective of this. So OMERS is a large Canadian pension plan based in Toronto. We manage a balance sheet of about $100 billion, of which about half is in private market strategies. And within its private market strategies, in its core strategies, it has been a direct investor only for a number of years. And those strategies include, in sort of order of magnitude, infrastructure, real estate through Oxford, private equity, and venture. And so they've really been a pioneer in developing individual direct investing teams that sort of are and skill sets which are analogous to the size of deals that they want to do in the market. And so as an evolution of that, over the last year, they established the Strategic Partnerships Group, which was the group I joined. And with that, this lens, what we're looking to do is we involve many other LPs in a lot of the investments we do and a lot of assets that we buy and own. And so what we're looking to is take a more organized and thoughtful approach to that. And so it's really to take a holistic approach and say, look, those like-minded investors, let's figure out ways to work together.
Now, you guys are huge, so you've got the experience and the capacity to be able to do that. Do you sense, though, that there are still lots and lots of LPs out there that just want the plain vanilla traditional way of accessing this asset class?
Yes, yeah. I mean, but they also they want to have more evolved conversation with groups like us to see what we're doing, to understand how there's an intersection between what we're doing and what their aspirations and deployment aspirations are, and to see if there's an opportunity to have a co-invest alliance or some other organized way of working together.
So, David, you've heard how your neighbours to the north are tackling this issue.
Right.
Does it look the same from the New York perspective?
Yeah, I'd say I'm inspired by my neighbors to the north, OMERS and other Canadian institutions. But I think it's easy to think that large plans are going in the direction of more direct investing, because we see that among Canadian plans. Even a large public plan in California, there have been discussions about a new approach to private equity. I'll make the bold prediction that 10-year limited partnerships are here to stay, right? I mean, I feel like if the market, would naturally evolve, I think it probably would have happened already, because, we are, in New York City, we're a $195 billion pension plan with a $20 billion private equity portfolio, so we write very large commitments. But a lot of LPs, if you look at, the LP list for partnerships and funds, I mean, it's a mix, right? It's not all, multi-$100 million commitments. So I think, and I think Laura made a great point, in order to evolve your strategy, you need the right skill set. You can't just go from, like, I wouldn't want, somebody on Ares who's a credit investor doing controlled private equity, just like I wouldn't want a, fund investor, an institutional investor, with a different type of skill set and background to start doing direct control deals. And I think that's the key thing, is having the right skill set and the right team.
Blair, what's your reflection on this, looking at it from the other side of the fence? Do you see this evolution of the GP-LP relationship?
I think it's bifurcated in that if we track, for example, our European direct lending business, Fund 1 had 10 LPs, Fund 2 had 30, Fund 3 had 60, and Fund 4, which we just closed, had 130. So clearly that's an attractive way for LPs to access the asset class, maintain diversity, et cetera. But, maybe to some of the points raised earlier, we are seeing in our asset class, which is more nascent, for example, than private equity, investors more interested in things like co-investment. So that's really starting to spread, I think, from traditional private equity co-investment, which is quite mature, to other asset classes as well.
Pierre-Antoine, I'd like to bring you in at this point and think about this new order a little bit more from the perspective of fund managers and the funds themselves. What are the main changes that you've been seeing in the way in which funds are organizing themselves, the way in which funds are structuring themselves?
So we work a lot with fund managers, and we provide financing to teams or to funds to continue to grow their portfolio. And one trend which we're seeing and which has been quite obvious for the last 5-7 years is we see longer-term funds and funds being raised with 15-year horizon, sometimes longer, sometimes evergreen structures, which command a different set of rules around liquidity and how investors can get out of these funds and find an exit. One theme which has grown since the crisis is all fund managers have increased their investor relation team, and there's definitely a strong focus on how much services can be provided to investors, and that's only for the better for investors, and it's a strong trend. It drives a lot of innovation, creation, and new ideas offered to investors. And we've seen stapled transactions offer partial or full liquidity to investors when funds get to year 8, 9, and different offers when the funds are in year 12, which is really when 10-year funds start to liquidate as year 12. You all know that. So all of that is driving new ways of thinking. I think it is happening. It's only for the better for the industry.
Yeah, can I just jump in there real quick?
Please.
I think, like, as a large limited partner, we have over 100 manager GP relationships. So from the investor relations perspective, we see the range. We have the traditional LP coverage, IR professional who sort of, when they divide kind of distribution and project management. But then, we have other GPs where you'll have an IR professional who, can walk through the portfolio and give you the portfolio review, and he doesn't have to call in a deal partner to go to every meeting. And from our perspective, we find that really useful because, then our day-to-day interaction with investor relations, you're speaking with somebody who can answer your questions real time, right? It's not I'll have to come back to you and, set up a separate conference call. And one of the things we've noticed on this theme that Blair brought up about co-investment is, at least on the equity side, there's some GPs who are now, starting to establish kind of a chief co-investment officer role because the IR team is overtaxed in terms of their responsibilities, and that allows you to have a centralized, function to interact with the LPs on these co-investment syndications. So we're definitely seeing the IR function itself evolve and become more mature and better resourced. It feels like, yeah.
Has that been your experience as well in Canada?
Yeah, I mean, within OMERS, you know, it's sort of, I think until the Strategic Partnerships Group was established last year, it was very much siloed by strategy in terms of how we interacted with others in our assets. And within infrastructure in particular, I mean, we raised a $12 billion co-invest alliance in 2012. So this is all experience that the team had, but the team very much bore the burden of dealing with the relationships and managing that. And that, you know, dovetails into the IR effort and making sure that you can manage that plus do your day job. That I think, you know, it's evolved into a more strategic group that can really look from the lens of the LP and make sure that the relationship is a successful one for whatever you're trying to do. And so really, I think it is one of those things that within, yes, we are a pension fund, but we very much have many relationships across the organization, and we want to have a much more thoughtful and organized approach to it.
This sort of professionalization, Blair, that we've seen, and Pierre-Antoine as well, I'll ask you both, is this just raising the cost of doing business as you start to create these more specialist teams, these larger teams? There are clearly advantages to it, but it makes running the business more expensive, doesn't it? Let's start with you, Blair.
So it does add fixed costs. That's the reality. Ares has invested meaningfully around the world in both relationship managers who are responsible for client relationships, as well as in investor relations who are really product experts in their own funds. And I think our view is that the bar for limited partners keeps going up. Limited partners are getting smarter, every year. So for Ares to compete and continue to foster those relationships and get re-ups and repeat business, we have to raise our game, and I think that's fine. But I think what we've invested a lot in is, frankly, being incredibly transparent with our investors, providing a lot of data, providing a lot of access. And we're also cognizant of the fact that many investors themselves have their own regulatory requirements that they have to deal with. For example, the reporting we do for our insurance company investors would blow your mind, but that's what you have to do to keep them happy. So I think our view is that, yes, it's a fixed cost, but hopefully it helps us grow our business and have stickier client relationships.
Is that what you see as well, that it actually helps solidify and cement the relationships, Pierre-Antoine?
It touches a very interesting point, which is, what is the real core business of a fund manager? Is it just to make investments and find the best investments in its own investment strategy, and then raising the money is a side business? Or is it really to take care of the clients, of the limited partners, of the investors who help you start a practice? And when you start a business, you have to have an investment team, but it starts with the money your first investors trust you with. They pay the rent, they pay the team, and so the business starts with the limited partners, it is the core business. Our job as fund managers is to make sure our investors get what they have signed for as much as possible in the most reliable way, and that's a core business. It's not a side business. It's a core business for us. Is it expensive? Does it matter? It doesn't really matter. It's our core business.
Yeah, I would just say we always say that limited partners are our oxygen. Without them, we would have no business. And we're also aware that limited partners have lots of choice in terms of GPs that they want to partner with. So I agree, it's incredibly important.
David, I'd like to turn to you now to ask you to say a few words about GP-led restructurings, which is something that's developed at quite a pace over the course of the last few years. It's hard to go now to an industry event without that being a topic. Is that a development from GPs that you see as being something positive? Is that a sign of a healthy relationship between GPs and LPs, or do you worry about the prevalence of that?
Yeah, I don't worry about it. I think it's and there was some of us attended the roundtable discussion, I think at 2:00 this afternoon. I think that first, I think it's important to get our vocabulary right, and unfortunately, I don't think the industry has it right yet. You have, if you think of secondaries, and then you think of like LP-led secondaries. So if a big public plan is selling a portfolio of LP interests, and Lexington and Ardian and HarborVest are buying that portfolio, that we all know about. And on GP-led deals, I think it's important to make the distinction between kind of GP-led restructurings, where it's perhaps a non-performing manager with some value in the assets, but they need to reset economics. That's very different from what we've all seen in the past 12 to 18 months, where you have GP-led secondaries, but they're much more constructive, where there may be a staple component, it could be a carve-out of assets, and those are trading at a premium because they're well-known performing managers. I think that latter example of GP-led deals, I think it's constructive because you're providing a liquidity option to your LPs. And as an LP, you can choose to sell at whatever the pricing is on that transaction. And oftentimes you're given the status quo option of saying, I'm not going to sell, I'm going to stay in fund whatever Roman numeral and live on the terms and conditions we agreed to when we made our fund commitment. So it's providing some optionality to the LPs. I think it's a permanent part of the market. And if you spoke to any of the secondary advisors, I think it's roughly, you hear ranges of like 25 to 30% of the current secondaries market is GP-led deals, and estimates that 5 or 7 years out, it may be half the secondaries market. So I think it's a permanent transaction. What's interesting, and we discussed this a bit at the LP session yesterday, is as an LP, as an investor, like how do you access that potential alpha, right? I think a lot of secondary firms have some allocation or they're doing some of these deals, but it's almost creating a completely different strategy within secondaries.
Did you want to jump in
No, I
on this?
think it goes exactly in the same direction as what I was mentioning earlier. More services, more options, taking better care of your clients and giving them choice. That's really what it is all about. And that's how you stand out. You can stand out with a different strategy, but having better services and being closer to your clients, I think, makes you stand out from your competitors.
Now, we've talked for the first 10 or 15 minutes about the developments, particularly in private equity markets. I'd like to move on now and talk a little bit about new and what I might describe as adjacent strategies. And Blair, you're here particularly representing the sort of private debt market, private credit, which has taken off hugely over the course of the last few years. Are we going to see more and more private equity firms diversifying into this market?
I make a couple of points. One is it has taken off. Ares has been a big beneficiary of that trend. We've now got 120 billion of assets under management as a firm, about 90 of which is in corporate credit directly. But we think it's really exciting because for anyone in the audience who studies private equity and leverage buyouts, this is completely transforming the leverage in the leverage buyout, because it's now being provided by groups like ourselves rather than banks. But why does anybody really care about this? I think there are a couple reasons. One, it's an attractive asset class. It offers contractual return and yield. A lot of pension plans have sort of 8+% return hurdles, which private debt, we think, on a risk-return basis, satisfies very nicely. It's a floating rate asset class. It offers short duration. And when you compare it to what you can get in the liquid fixed income markets, I'd say, and arguably the private equity markets, it looks good. And it just so happens that that's, from an LP perspective, fitting at the same time where we're seeing, I would say, the debanking, broadly speaking, of the world, where, again, groups like Ares and others are gaining market share. In terms of sort of where we are in other groups, I think it's our perspective, in particular in Europe, that the most successful firms doing this tend to be alternative asset managers and sort of credit specialists. There are some private equity firms that do it as well. But in terms of more getting in, it's interesting. We believe that the competitive dynamic for what we do in Europe has been pretty stable for the past several years. We've not seen a lot of new entrants. We think the reason for that is, frankly, getting into this space is incredibly expensive. In particular, talent is the scarce resource. The talent helps you sort of originate and source investment opportunities. Plus, our fee structure is a little different from PE. We get paid on invested capital, not committed. So if someone were to decide to get in this space in a meaningful way, it's quite an expensive proposition. So actually we've seen, I would say, the competitive situation with sort of other private equity firms, et cetera, getting into the business really leveling off.
Laura, how do you think most LPs look on the private debt market? Is it an alternative to PE, a complement, handled in a completely different way? How does it fit in the mix for a big LP like OMERS?
Yeah, I mean, well, OMERS takes the perspective of, in terms of its sort of core private market strategies, it will develop and has developed its own internal direct investing capabilities. But for something like private debt, we have an existing relationship with Ares. You know, it's one of those things that we know, you know, we want to make sure that for other strategies, we very much own the capability, and then, you know, in other areas, rent it.
And for you guys, David?
Yeah, I mean, I think as a public plan, we see, I mean, it's not really in private equity at all. It's sort of its own strategy and asset class. And I don't know, Blair, maybe you've seen this with your LP base over time evolve, where like MES used to be in private equity, right? Because where else does it fit, you know? And then you sort of had pension plans form their own kind of opportunistic fixed income or private debt groups. And that's how we're organized. We have a separate team that does, you know, direct lending, like from MES down kind of is like our private debt group. And I think most, at least in the United States, most plans are organized that way, where you'll have a separate private credit team.
How worried are you, Blair, and how worried should we all be about the prospect of a kind of regulatory clampdown on the private debt market? One of the reasons, arguably, that it's been able to grow so dramatically is because policymakers have actually been supportive of it and encouraging of it, because the banks have been shy about lending in certain sectors. But at some point, something will go wrong, and the risk is that a politician decides to hammer you.
Yeah, you know, I would say in the list of things that kind of keeps me up at night, that's not near the top. But it is a topical thing in that in certain other countries, you know, shadow banking is closely looked at. I think our perspective on that is that debt funds like ourselves, you know, we're not systemically important to any economy. With respect to banking regulation, you know, we don't take customer deposits and then lend them on. We have very sophisticated limited partners like the ones on this stage that we invest for. We also match our assets and liabilities in our structures. So I think if you look at the reason sort of why we should be regulated that way, it doesn't exactly fit. That said, obviously we are a regulated fund manager like the private equity industry is by the FCA and other bodies. What's interesting, however, and you alluded to this, you know, we've seen governments in particular in Europe view private debt as a force of good as the banking sector has been challenged. So for example, you know, several years ago we were given capital by Her Majesty's Treasury here in the UK to invest specifically in UK businesses, and we've had similar conversations with other governments around Europe. We've also seen countries like, you know, Italy in particular sort of loosen regulations that have made it more difficult for private lenders to be active. So again, I think that the wind's blowing a little bit the other way, and that we're viewed as more of a force of good.
If anything, on the regulatory front, I think that one of the threats of the industry is that it makes it more difficult to start a new asset manager today, and it creates more barriers to entry. And for an industry to be efficient, you need new entrants, you need new players, new investment strategies, and LPs have historically been supportive of new ideas, and but the regulatory front is making it more difficult and more expensive really to start. It's an expensive business to start in today.
It's better to rent it. It does good. I like that, rent it from
The red light is starting to flash before my eyes here. I don't think that's an imminent stroke or anything. I think it's a sign that we're coming towards the end of our session. I want to give you each one last opportunity for a quick soundbite answer to the question, what's the biggest opportunity for the industry over the next decade, and what's the biggest threat?
I think we take the view that, just broadly speaking, the industry is, you know, relatively mature in a lot of ways, and certainly as a credit person, we're more glasses half empty than half full. So actually, we think the greatest opportunity and threat are interrelated, which is to say there will be a downturn in the near future, and the opportunity is to manage that in a disciplined way and come out the other side and sort of continue to prove the worth of the alternative asset manager space. And obviously the risk is not doing that, having paid high prices for businesses, maybe over-levered, we were talking about earlier, coming out the other side and having LP say, you know what, I just want to put my money in an index fund or something.
Laura?
I think in terms of, I'll go with the threat first, I think it's across our private market strategies, it is asset prices. Because the impact of that in the longer term, I mean, we think about our pensioners first and matching those liabilities and making sure that we can, provide retirement funds for them. So making sure that our returns are in line with the expectations to allow us to be successful at that. In terms of the opportunity, I think, for me personally, it's the evolution of really, seeking out those like-minded LPs that would benefit from the OMERS platform and working together successfully with them.
David?
Yeah, I think from taking a limited partners perspective, I'd say the greatest opportunity is probably over the course of the next, 10 or 15 years is identifying and supporting like new and early stage managers. And I think the threat from an LP perspective is alluding to what Blair mentioned as, a downturn, because like cycles are a permanent part of all of our reality as investors and GPs and LPs, is for LPs to remain disciplined in their pacing, right, in terms of their fund commitments, because we've all seen the charts where limited partners pull back exactly when they should be continuing to invest at a consistent pace. So I think that's the LP perspective.
Finally, Pierre-Antoine.
Biggest opportunity, consolidation of the industry, and biggest threat, excessive leverage.
Fantastic. Laura, David, Pierre-Antoine, Blair, thank you very much. Thank you. Thank you all.
Thank you.